This is David Ranson, and welcome to our client webcast for the month of November, which is on a theme: the restoration of the economic and capital market status quo. At ground level, it's true that life will never be the same again after the pandemic. But the view from 30,000 feet is quite different. The economy has endured a period of acutely depressed activity and distorted capital market prices, but, relative to past recessions, it's been very brief. This webcast reviews many of the respects in which the status quo has returned or is well on the way back. So far, even the new wave of coronavirus infections and deaths is not holding up this restoration of broad-brush normalcy. Risk tolerance, employment, and government indebtedness are among a handful of economic features that take a much longer time than the rest to recover. Lower risk tolerance may imply a reduced growth rate in the coming years, but in hindsight, what will have changed is the shape of the economy rather than its size or the price mechanism that drives it. The economy's bounce back from shutdowns was a natural phenomenon and not the result of government stimulus. Recovering risky asset prices. One of the earliest signs of a return toward normal was the bounce back in the equity market. The market has changed its shape, with vitality shifting away from value toward growth. But the overall speed and completeness of the recovery has been much greater than following past economic setbacks. Exhibit 1 compares the stock market recovery with those of high-yield bonds and commodities. These other capital markets do not enjoy the liquidity or depth of the stock market, so their recoveries have been slower, as they traditionally were in the past, and are still underway. In every recovery, there's a short period of disorientation during which risky asset markets are already on the rebound while the economy is still falling. That's because financial markets are frictionless and naturally move faster than economic activity itself. As Exhibit 2 shows, various aspects of the economy bottomed in April, a month later than asset prices. The chart also underscores the different rates at which these economic variables recovered. The market for consumer goods, reflected in retail sales, rebounded completely in 2 months. But the labour market, which is much less liquid, took twice as long to get halfway back. History suggests that it will take many years to return to the status quo. Heavy industry, where decision-making is bureaucratic and competition is less intense, has been equally slow to recover. At the end of October, finally, official data became available to put in perspective the plunge and rebound in the overall economy. Exhibit 3 shows the quarterly path of real GDP this year, its clear V-shape, and the imperfect recapture in the third quarter of the ground lost during the second, about 82%. For the fourth quarter, we have an early estimate of 11.0% annualized growth from the Atlanta Fed's GDP Now website, based on raw provisional data. This suggests that the rebound has not finished yet and will not be completed until the end of the year. As of quarter 4, the net decline in GDP from a year earlier will be less than 1%. The decline in calendar year GDP from 2019 to 2020 now looks to be 3.1%, substantially better than forecast by most conventional sources. And arithmetic requires that the negative growth in calendar year 2020 will be counterbalanced by a growth surge between calendar years 2020 and 2021. A spike in new business formation. While heavy industry is recovering only slowly, the small business sector is another story. This is where the resilience of the economy is most impressive. There was a large wave of bankruptcies in the second quarter, but in quarter 3, new business formations soared to record heights, as shown in Exhibit 4. Incredibly, it was the sector that was most vulnerable and most damaged in the crisis that has provided most of the momentum for recovery. Small business is capturing a larger market share of the economy as a result of the pandemic. Forecasts of higher inflation and a weaker dollar are now commonplace, but they are based on extrapolating what has happened to both since the spring. It's probably a mistake to extrapolate in this instance. The perspective in Exhibit 5 suggests a different diagnosis of the situation. Both the dollar and the level of prices for consumer and producer goods are returning, asymptotically, to the status quo. Exhibit 6 shows the Fed's preferred measure of inflation on a quarterly basis since last year in the left panel. Before the crisis, inflation was running along consistently at a rate of around 1.5%. It became negative in the second quarter, but bounced back to highly positive in the third. Meanwhile, unemployment, in the right panel, it took an exactly opposite course, sharply up in quarter 2 and down in quarter 3. The conjunction between inflation and unemployment, looking like this, has occurred in previous recessions. It could be the source of the mythical Phillips curve, which at other times is invisible. Productivity before and after the crisis. Productivity is another feature of the economy which was temporarily distorted by the shutdowns. Exhibit 7 illustrates its return toward the status quo. In the second quarter, government relief payments allowed businesses to keep many workers on the payroll even when output was cut. Productivity as a result dropped by some 10%. But when revival began, employment could not keep up with the rebound in output. Among the unemployed, businesses found it more urgent to bring on board back the most critical and productive workers rather than rehire the rest of the workforce. In the fourth quarter and beyond, productivity is likely to rise above what it was before the crisis, because there's the shortage of workforce, but then it would return slowly to the status quo. Saving played a counterintuitive role during the crisis. The standard theory supporting extreme monetary and fiscal policies asserts that they'll stimulate consumer spending. But economists discovered back in the 1960s that people who receive windfall income tend to save it or use it to reduce debt. Exhibit 8 shows that this is exactly what happened this year. As businesses and families received relief payments and other benefits in the second quarter, the saving rate spiked. It then fell back in quarter 3 as unemployment benefits expired and the parties in Washington couldn't agree on a new stimulus program. It would probably soon return to the normal level of about 7% in the normal course of events. However, if new fiscal or monetary stimulus actions are taken after the Trump administration leaves office, another surge in the saving rate is to be expected. As a whole, this experience suggests that the recipients of government relief prefer to use their benefits to pay down their debts or save rather than increase their spending. These stimulus programs appear to have less effect on the economy than advertised. So if it was not the government's massive relief programs that fueled the US economic rebound, then what was it? The most likely answer is natural resilience. Exhibit 9 shows that the countries with the most vigorous recoveries were those that had contracted most in the crisis. The US rebound was actually smaller than in several other major economies, even though it had by far the most generous stimulus actions, amounting to about 11% of GDP. China had a much bigger rebound despite the fact that its stimulus actions were only 1/10 as large. Overall, no connection is visible between the magnitude of government stimulus efforts and the vigour of the rebound that accompanied the lifting of shutdown. At this stage, I'd like to introduce, my colleague David Campbell, who represents our work in the United Kingdom, and David has constructed some questions for me to address. David.
Given the resilience of the US economy, with aggregate output bouncing back strongly, and given the continued monetary and fiscal stimulus, would you not expect inflation to rear its head quite soon?
Probably not. The output bounce back merely brings it up close to where it stood at the beginning of the year. And even if the year's net growth had been positive, that would still have been no reason for a boost in inflation. Nor have monetary and fiscal policy actions been historically inflationary. The link is a theoretical one, for which evidence is hard to find. Following the extreme policy actions of 2008-09, there was no inflation boost. And as Exhibits 5 and 6 above demonstrate, there's no sign yet that inflation is doing more than return to the status quo at the beginning of the year. At the micro level, it's true that a supply-demand imbalance for a particular product will tend to drive up its price relative to other goods and services. But to drive up money prices in general, the value of money must fall, and that has not happened.
The recent weakening in the gold price suggests that inflation anxiety is not a predominant concern for investors. But given the long-run hedge versus equities provided by gold, is the latest fall in the gold price an opportunity for portfolio investors?
Not a tactical opportunity, no. It's true that annual returns from gold and stocks are inversely correlated, but neither is easy to predict without unusual foresight concerning the direction of flow between risky assets and safe havens. So the opportunity is strategic rather than tactical. By devoting a permanent fraction of an equities portfolio to gold, either bullion or paper gold, an investor can greatly improve the balance between return and volatility.
The debate about growth versus value continues. Service sectors hit hard by COVID restrictions are expected to gain from the distribution of the now proven vaccines. Could this be a big turnaround for long disappointed value investors?
Well, vaccines should certainly enable a partial recovery in service industries that have been directly affected by social distancing. But the development of vaccines was never in question, only the timing. So even if the availability of a vaccine is imminent, the benefit to value stocks may well be already in the price.
David, you have been expecting further recovery in the valuation of high-yield bonds. Is this not a difficult call, given that government bond yields are at historical lows and that the universe of high-yield issues must have changed a lot in the last few years?
If anything, the price correlation between governments and junk bonds is inverse. So a rise in government bond yields from their historic lows would tend to be bullish rather than bearish for high yield. The universe of high yield issues has certainly been rotating during the crisis as defaults rose and new enterprises were launched. But now that the economy is back to firing on all cylinders, the default rate should be expected to decline. It's not difficult to anticipate that high yield prices will continue climbing given the complete recovery that has already occurred in the stock market. Well, I'd like to thank David for his questions. And just a word about topics for future publications, the most immediate of which concerns the behavior in the stock market across the world of countries where there's a big surge in coronavirus deaths. The question is, how can stock markets ignore coronavirus deaths now, when the effect of the threat of coronavirus was so very intense in the winter? And that we will be producing by the end of this month a commentary on these questions. Thank you for listening. The next client webcast will be in January, around about the end of the month, and it'll be a survey of how capital markets and the economy are beginning the new year. Thank you for listening, and I look forward to the next webcast.